All right, guys, the daily reading is upon us. We must get the hymn books. Bitcoin 1 million. Hardback edition. Very important. I don't know if anybody's. Let me just make sure.
Holy, holy, holy.
Holy moly. Let me just see if we got where anybody's. I'm making sure that we got. Oh, yeah, we are live. Okay, we're good. Okay. So behind us, we have a wall, a literal wall of sweat. Something else, man. Something else. All right, let's go back to the Bitcoin drop.
Yeah. Thank you for coming to Bitcoin 1 Million Church today
Yep.
for your daily devotional reading.
Now this is a
Get your Bibles.
this is a hardback author's proof. The actual it isn't misaligned like this in the actual book.
Yeah.
But, and this one actually has a white thing, but the real one's cream.
Do you like the white one? Or?
I kind of prefer the cream.
Me too. The white one feels like a textbook to me.
Yeah, a little bit.
A little bit textbook.
We're going to a subject that we're going to be reading from. This is a short chapter. It starts on page 67, and it goes to page 80. So it's about 13 pages. So it's not too bad. So let's start with bonds. Bondos. Okay. Bonds. This chapter exposes why the 130 trillion bond market, trapped by outdated allocation models and institutional inertia, represents Bitcoin's greatest opportunity. As an ex-Salomon Brothers bond trader, I'll show you why the 60-40 portfolio is a wealth destroyer, why institutions are prisoners of their own rules, and why even central banks are beginning to abandon bonds for alternatives. The day that Silicon Valley Bank died. On March 9th, 2023, boy, it feels like it's been that was just yesterday, but it was really.
I can't believe that.
That was 2.5 years ago.
There was a Silicon Valley Bank branch down here.
Yeah. The Silicon Valley Bank announced it had sold. Silicon Valley Bank had announced it had sold $21 billion in government bonds at a $1.8 billion loss. Within 48 hours, the bank was dead. The second largest bank failure in American history, triggered by assets the regulatory classified as risk-free. The irony was perfect. SVB had done everything the textbook taught. Load up on long-duration government bonds during the pandemic when cash flooded in from tech companies. Those weren't risky derivatives or subprime mortgages. They were the safest assets in the world, backed by the full faith and credit of the United States government. The Fed had promised rates would stay near zero for years. What could go wrong? Everything. When the Fed raised rates at the fastest pace in 40 years, those safe bonds lost half their value overnight. SVB's depositors, spooked by social media rumors, withdrew $42 billion in a single day, the first Twitter-driven bank run in history. But the real killer wasn't the bank run. It was the bonds. This wasn't an isolated incident. Credit Suisse, a 167-year-old institution, collapsed the same month. First Republic followed. Regional banks across America teetered as their safe bond portfolios turned toxic. The Fed's response? Create the Bank Term Funding Program, BTFP, allowing banks to pretend their underwater bonds were still worth face value. Systematic accounting friction on a massive scale. You want to read the 130 trillion zombie market?
Yeah, you know what? You should.
Or you want me to read?
You know, I'll read it. But I was thinking about the Silicon Valley Bank when it did go under. Remember we went down to the lobby and there were like all these chairs set up for people to wait.
Oh yeah.
It was like the following week when they were completely dark.
Yeah.
And they had like one guy working there.
And the guy would just come in and people would be like, "Where's my money?"
Yeah, but he'd come out and be like, they had a security guard in the one guy, and he'd be like, Mr. and Mrs. Smith or whatever.
Yeah.
I remember seeing this old couple that looked like, remember that, that farmer in that painting?
American Gothic.
American Gothic farmer.
With the pitchfork.
They looked like those people, but they were so sullen. They were sitting there in those chairs, like holding hands. They looked so scared about what had happened to their money.
Yeah, it's
like it's so frightening.
Yeah.
So I was kind of like, what? How this farmer of all his money?
I mean, you think it can only happen in Lebanon or Cyprus.
That's what was amazing about it. That happened right here in our building.
Yeah, it's just unbelievable.
And we put up a little sign on the door that says "Bitcoin never closes."
Yeah, we put that up. It was there for a couple days.
It was pretty funny, honestly. There were some photos of it, but the 130 trillion zombie market. So Silicon Valley Bank's death revealed the truth about the global bond market. 130 trillion in assets trapped by allocation models designed in the 1980s, when bonds actually provided safety and yield. Today's bond market bears no resemblance to what Fred traded at Salomon Brothers and Greenwich Capital in the late 1980s and early 1990s, when yields actually compensated for risk. Back then, back in my day, you could buy a 30-year treasury yielding 8% when inflation ran 4%, providing a real return of 4% annually. Not bad. The logic made sense. Lend money to the government, get paid a premium for the time value and inflation risk. Retire comfortably on the interest.
Now, I will say, a lot of people in the 80s actually retired with bonds. They had these bonds, the bonds paid them money, and they just held on to the bonds. And some of them outlived their bonds, right? So they bought 30-year bonds, but then they kind of lived more. And then they were like, oh, what do I buy now? Of course, by the time their bonds were over, the bond yields had collapsed about 2% or 1% or 0. So you had this big problem that everybody had gotten addicted to just these super high rates of interest that we had in the early 80s.
Exactly.
And, the bonds through QE, otherwise they would have been up, but through QE,
they got destroyed. Which we're going to talk about now.
Yeah.
Today's bond market is unrecognizable. Central banks own half the market through quantitative easing. Yields hover around 4 to 5%, while money supply grows at 7% annually, creating a guaranteed 2 to 3% annual loss in purchasing power. We actually have a chart here on global bond growth.
There's the global bond growth. So you can see it's exponential. It's growing at about 7% a year.
It's 11x over 39 years.
Yeah. So, when I was there, when I started 1985, I was actually at Salomon Brothers in 1985. The bond market was 10 trillion, the global bond market. Now the global market's 130 trillion. So it's gone up 13x on my watch. We could not, I was just talking to, some of the people who are on the desk with me the other day, and we just could not believe. Like, if you told me that the U.S. government was 38 trillion, I would say, no way. Like, if you think we were going to get there, I'd say the only way we're going to get there is for the U.S. to go default, or there would be riots in the streets. There's no way. I mean, we were at about $1 trillion when I was on Wall Street. 1 trillion, 1.5 trillion. I remember that the idea of $1 trillion debt was just unreal. It was unfathomable.
Was the thinking then that the debt would come down?
Yeah. I mean, Reagan had this idea of balanced budget amendment. I don't know if you remember that.
He was trying amendment to the Constitution.
He wanted to pass this balanced budget amendment that we would have this, balanced budget for eternity. And, look, in 2000, Clinton actually managed to balance the budget. So for a couple of years, I think 99, 2000.
Right. That was the last time.
That was the one and only time.
The one and only time we've had a balanced budget in our lifetimes.
Yeah. Anyways, let's keep going.
All right. So
after
taxes, you're losing this 3 to 4% a year. A slow motion wealth confiscation that makes Bernie Madoff look like an amateur. So yet institutions continue to hold 130 trillion in these instruments. Why? Because their allocation models, regulatory requirements, and career incentives haven't been updated for the age of infinite money printing. No pension fund manager gets fired for owning bonds. even when those bonds guarantee failure to meet return targets. It's the institutional equivalent of the Nuremberg defense. I was just following orders from my actuarial consultant.
Right. So that was the, a reference to the
Nuremberg
Nazis
trials.
who were being, tried, and the Nazis being tried in The Hague and Nuremberg.
Hitler
And they were
told me
like,
to do it.
I was just following orders.
orders.
It wasn't me. I didn't have the great, brilliant idea. No. Let me read this. The prisoners of asset allocation. The bond market continues to operate on asset allocation models designed in the 80s. We should change that to a little bit of repetition. Can we make a note? Despite changing market conditions. These models developed when bond yields used to 8% was the default, was the safe asset. Now mandate that institutions lose money systematically. The institutional framework reveals 4 key players trapped by their own allocation rules. Pension funds hold 40 to 60% in bonds because their actuarial models, designed in the 70s, assume bonds provide steady income to match liabilities. These models haven't been updated for negative real yields. Pension consultants won't change allocations because they'd have to admit decades of bad advice. Meanwhile, they need 7% returns to meet their obligations, but they hold bonds yielding 4%. Insurance companies hold 60% to 80% in bonds due to regulations written when bonds were actually safe. State insurance commissioners mandate these allocations for safety. Regulators continue to require insurers to hold these assets despite negative real yields. When policyholders need payouts in 20 years, these bond holdings will have lost half their real value. Banks stuff their reserves with government bonds deemed risk-free by Basel III regulations. Silicon Valley Bank collapsed in 2023 precisely because of these safe bonds. They lost 50% when rates rose. The Fed's 2022 rate hikes were a warning shot. The era of predictable bond behavior is over. Retail investors religiously follow the 60-40 portfolio, and for no reason. It's just the religion is just a 60% bonds, 40% bonds, 60% stocks, 40% bonds, because every financial advisor learned it in their Series 7 exam. I passed the Series 7. And the Blue Sky for New York. The Series 7 is an exam that all people in FINRA, registered financial representatives, have to take. So everybody takes the Series 7. The allocation made sense when bonds yield more than inflation. Today, it's financial malpractice. The 40% bond allocation is dead weight, dragging down returns while providing no real diversification. So this is the actual pie chart of the bond market ownership.
Right.
And you can see, it's neglected. Most people don't realize this because at this point, if you're a boomer, you probably own a few bonds, right? But if you're a millennial, the chances are you own no bonds at all. Even if you're a Gen X, you might own a few bonds, but it's kind of like this old boomer class thing that has just permeated the world. Yeah. But it's so big. I mean, people don't understand. It's actually bigger than the world stock market right now. It's like, it gets no press. 95% of all, 99% of all CNBC is stocks, not bonds. And yet it's 50-50 in reality. The entire mathematical framework creates tremendous resistance to change because admitting bonds are broken means admitting decades of advice was wrong. Pension funds can't abandon their actuarial models without acknowledging they've been failing for their beneficiaries. Insurance companies need regulatory approval for major allocation changes, and regulators won't approve what they don't understand. Banks would have to recognize massive losses on existing bondholders if they admitted these holdings were toxic. The entire system is trapped by its own momentum, like a freight train that can't stop even when the bridge ahead has collapsed. Okay.
The sovereign abandonment. While institutions remain paralyzed by their own frameworks, the smartest money is already leaving.
Yeah.
Central banks, the supposed guardians of the bond market, are quietly abandoning their own product. China stopped buying U.S. treasuries in 2014. They've reduced holdings from 1.3 trillion to 800 billion while accumulating gold. They see what's coming. The US will print away its debts, and foreign bondholders will pay the price. Russia dumped their entire treasury position before the Ukraine war. Saudi Arabia is diversifying reserves away from dollars and bonds. Even Japan, America's most loyal creditor, has started selling. These decisions reflect analysis. When 30-year treasuries yield 4.5% while US money grows at 7%, the real return is negative. Foreign central banks aren't stupid. They're just early. The replacement isn't more bonds from other countries, it's hard assets. Gold purchases by central banks hit 50-year highs in 2023.
And they've gone even higher today, yeah.
But gold is last century's solution. The smart money sees Bitcoin as the next evolution. Scarcer than gold, more liquid than bonds, impossible to confiscate or inflate away. If a major central bank, when a major central bank announces reserves, this will stimulate its influence other essential investors. Yeah.
So one of the things I just was mentioned, this book is kind of a living thing. So if you notice this book and chapter 1, we have this version number, right? And everything on this book is in GitHub. And so we can update it. So we actually are updating this thing in real time. We reread it. We read it like now on video. We read it to ourselves, and we're like, yeah, change this. So we tweak the book.
Yeah.
Okay.
I'm just making a note of that. Really
okay. Perfect.
What's the note we're going to change? Oh, yeah. When major bank.
Yeah. Exactly.
Not if.
Yep.
Bonds. What was the other one we wanted to change?
It was just a little bit of repetition at the idea about
the outdated models.
Outdated models, yeah.
In the beginning of the prisoners.
Yeah. I'll read the next section line here. The 2022 wake-up call. The Federal Reserve's rate hiking campaigns of 2022 to 2023 was supposed to tame inflation. Instead, it revealed the fundamental fragility of the entire bond-based financial system. Jerome Powell had spent 2021 promising that rates would stay near zero for some time and that any inflation would be transitory. By March of 2022, with inflation hitting 8.5%, the Fed was raising rates at the fastest pace since the early 1980s, destroying every institution that had believed their promises. Silicon Valley Bank had become the poster child for this carnage, but the rot extended far deeper. SVB had done everything by the textbooks taught. Load up with long-duration government bonds during the pandemic when cash flooded in from tech companies. These weren't risky derivatives or subprime mortgages. They were the safest asset in the world, backed by the full faith and credit of the United States government. When the Fed raised rates, these bonds lost half their value overnight. Credit Suisse, a 167-year-old institution that had survived 2 world wars and the Great Depression, collapsed because rising rates had gutted their bond portfolio. First Republic followed within weeks. Regional banks across America saw their tangible book values evaporate as safe government bonds lost 30 to 50% of their value. The supposedly risk-free asset class had become the riskiest thing you could own. The Fed's response revealed everything you need to know about the current system's stability. Rather than acknowledge that bonds had become toxic, they created the Bank Term Funding Program, a fancy name for letting banks pretend their underwater bonds were still worth face value when borrowing from the Fed. It was extend and pretend on a systematic scale, accounting fiction that would make Enron blush. But you can't pretend forever. Those bonds are still worth 70 cents on the dollar. The losses are still there, hidden by regulatory capture and accounting gimmicks. Every bank in America is technically insolvent if they mark their bond portfolios to market, which is why they don't. The entire system runs on the fiction that assets losing money in real time are somehow held to maturity and therefore immune to market forces. This experience taught the smart money a crucial lesson. Assets with supply controlled by politicians and central bankers are not safe, regardless of what regulators claim. Some investors began seeking alternatives with immutable supply schedules that cannot be manipulated by monetary policy decisions, assets like Bitcoin, where the supply curve is written in code rather than Fed meeting minutes. All right, you want to go to the coming rotation?
Just trying to keep the ship afloat over there.
Okay.
Coming rotation. The potential rotation from bonds to Bitcoin follows from analysis of their relative returns. Every trend points the same direction. Sovereign abandonment accelerates as countries recognize US debt won't be repaid in real terms. Institutional awakening begins as the first movers break ranks to allocate to Bitcoin. Regulatory evolution forces changes as outdated rules meet reality, and generational transition brings managers who understand technology, not just tradition.
I think that's important, by
Yeah,
the
it
way.
is
I think that, we are seeing a changing of the guard.
The generational change.
When you have the old guys like Mohammed El Arian, from Allianz, formerly from PIMCO, those are the guys like Bill Gross who ran the bond world. But now we're getting newer people, right? And these guys might actually own some Bitcoin. Their kids will own Bitcoin. They're different people running the show. Okay, keep on going.
Right. So competitive pressure intensifies as early Bitcoin adopters dramatically outperform bondholders. The projected timeline includes 2025 to 26. Family offices, small pensions experiment with 1 to 2% Bitcoin allocations. Estimated 50 to 100 billion inflows could drive Bitcoin to $150 to $250,000.
Now, it's very important to understand. When you look at 100 trillion plus in assets, if 1% of that moves, that's $1 trillion, right? If you have $1 trillion coming into Bitcoin, that's not going to move Bitcoin from 2 trillion to 3 trillion. That's going to move Bitcoin from 2 trillion to 20 trillion. That's the multiplier effect we covered in the previous factor. So the market is so large that 1% change alone could move us to $1 million a coin.
2026 to 2030, major institutions announce Bitcoin allocation. Insurance companies establish positions. Corporate treasuries abandon bonds for Bitcoin. 200 to 500 billion inflows push Bitcoin towards $600,000.
Yep.
Now, I'm sorry, 1 second, but what wasn't Allianz one of the people who's buying the bonds from Saylor?
They were. They bought.
Weren't they the biggest?
They were the biggest institutional player. They bought some of the convertible bonds,
right,
that were issued in November. Saylor issued $3 trillion,
he's part of
$3 billion worth of convertible bonds, and Allianz bought. I want to say they bought $400 or $500 million worth of convertible bonds.
This is an example of how, just like in real estate, Gary Cardone's model is like a bridge to Bitcoin.
Yeah.
This is a bond bridge.
And it wasn't really, it was a convertible bond, so they can buy a bond. They are allowed to buy a bond, right? Because the convertible bond has a maturity. It has a coupon. It has a kicker, right? Which is you have this kicker bond. This, if Bitcoin goes up, the convert's worth more, right? It's convertible into shares of MSTR. And so Allianz bought that bond. And I think there could be much more of that, depending on, obviously, whether these companies go back to issuing bonds, convertible bonds. But as we will talk, we think that there's going to be many more than just MSTR issuing Bitcoin convertible bonds. And we have a whole chapter on bit bonds. So let's keep on going.
Yeah. 2030 to 2035, central banks diversify reserves into Bitcoin. Sovereign wealth funds make major allocations, and the great rotation accelerates. 500 billion to 1 trillion drives Bitcoin past 1 million.
Right. So basically, we sort of think that
it's honestly, this could even be a slightly bearish view.
Yeah, people are like, why so bearish?
Yeah.
Yeah.
So several factors could accelerate this transition. Persistent negative real yields, evolving accounting standards for digital assets, potential central bank adoption, institutional performance comparisons, and generational changes in investment leadership. So these factors all could reinforce one another. As institutions begin adopting Bitcoin, the competitive pressure on others may increase.
All right. The next chapter, the next section, the death of the 60-40. Every financial advisor in America learned the same allocation with their Series 7 exam: 60% stocks, 40% bonds. This analytical formula became gospel because it worked brilliantly for 40 years. From 1980 to 2020, as interest rates fell from 20% to zero. Okay. Bonds provided both returns and diversification, rising when stocks fell and delivering steady income that exceeded annual inflation. Those days are dead. Most portfolio theory assumed bonds and stocks moved in opposite directions. When economic stress hit stocks, investors fled to the safety of bonds, driving bond prices up as stock prices fell. This negative correlation was theoretical foundation that justified holding 40% of your wealth in government IOUs. But that theory depended on an environment where central banks weren't actively destroying currency value to bail out over-leveraged governments. The 2022 market collapse shattered this illusion permanently. Stocks and bonds fell together in the worst performance for a 60-40 portfolio since the 70s. This is really important. This was like, people thought they were diversifying. It actually made it worse, right? Right. If you just had stocks, you were much better off than if you had stocks and bonds. So this did not work at all. And I got to tell you, I think that we are setting ourselves up for a repeat of this, not immediately, but 3 years from now, 4 years from now.
Oh, with Bitcoin.
We are going to be lowering interest rates. Everybody's going to get reallocated with too much bonds. Same story is going to play out again. And then, at some point, they're going to have to raise interest rates, and it's going to hold things going to collapse. Why? Because investors finally recognize that both assets are vulnerable to the same enemy: inflation caused by monetary expansion. When money supply grows faster than economic output, both stocks and bonds suffer as investors demand higher returns to compensate for currency debasement. The correlation between stocks and bonds has flipped from negative to positive, destroying the foundation of diversification. Holding bonds no longer provides protection during stock market stress. It provides double exposure to the same monetary risks. That 40% bond allocation has become deadweight, dragging down returns while providing no defensive benefits. The new allocation for the Bitcoin era reflects this changed reality. 70% Bitcoin represents monetary energy storage, scarce digital property that appreciates as fiat currencies depreciate. 25% stocks provide exposure to productive assets with pricing power that can navigate inflationary environments. 5% cash offers short-term liquidity for opportunities and emergency. 0% bonds reflects the reality that government IOUs offer guaranteed purchasing power destruction. You might notice real estate is missing from this allocation. We'll address why property can't compete with Bitcoin in the next chapter. This allocation positions for the world as if it actually exists, not allocation models from 1982, not as allocation models from 1982 pretend it should be. Financial advisors trapped by institutional constraints may struggle to recommend such departures from orthodoxy, but the data doesn't care about career risk. Large bond allocations guarantee inferior returns in an environment where governments print money to service unpayable debts.
Why Bitcoin wins. Bitcoin offers everything bonds pretend to provide, but actually delivers. True store of value. Bonds lose 2 to 3% annually in real terms. Bitcoin has significantly outperformed bonds on an annual basis. Predictable supply. Bitcoin's monetary policy is fixed in code and immutable. Bond supply depends on government spending, which only goes up. In the last year alone, the US issued $2 trillion in new bonds. No counterparty risk. Bitcoin requires no government to stay solvent, no central bank to maintain value, and no insurance company to make good on promises. Bonds require all three, and all three are failing. Superior liquidity. Bitcoin trades 24/7, 365 globally. Bonds trade in fragmented markets with limited hours. In a crisis, Bitcoin liquidity persists while bond markets freeze. Inflation protection. Bitcoin's scarcity makes it systematically immune to debasement. Bonds get destroyed by inflation. The 30-year treasury lost 50% in real value since 2000. The performance differential between these asset classes has been substantial, over Bitcoin's existence. One depends on government promises, while the other depends on mathematics. One represents the past, and the other represents the future.
Okay, the institutional prison break. Somewhere in an investment committee meeting room, probably within the next 18 months, a major institution will break ranks. The algorithm will be impossible to ignore. The opportunity costs unbearable, and someone will finally say what everyone knows. Bonds are broken, and Bitcoin is the answer. It might be CalPERS, the $500 billion pension fund, finally admitting they can't meet 7% return obligations with 4% bonds. Now, it's really important to understand the pension funds are all underfunded. They can't provide what they are claiming to provide with the tools that they have in front of them. They can't. So their actuaries will present the stark numbers. You continue losing 3% annually in real times, or you allocate 10% to an asset that has been averaging 100% returns. The fiduciary duty will become clear. It could be Berkshire Hathaway sitting on 150 billion in cash that Warren Buffett admits is not attractive at current rates. When Charlie Munger passed away in 2023, he took with him the institutional resistance to Bitcoin. The new generation of Berkshire managers understands that 150 billion earning 4% while losing 7% to monetary expansion is a slow motion disaster that would make Graham and Dodd weep. Perhaps Norway's $1.5 trillion sovereign wealth fund will lead the charge, pivoting from negative yielding European bonds to positive appreciating Bitcoin. I will mention that Jack Dorsey met with the Norwegian sovereign wealth fund recently in the last month to make the case for Bitcoin. Their mandate requires maximizing returns for future generations. Hard to justify holding assets that guarantee those generations will be poorer. Whoever moves first will benefit from favorable entry prices, while Bitcoin remains a relatively small $2 to $3 trillion asset class. Early institutional adopters will achieve differentiated performance that makes them heroes to their beneficiaries and pariahs to their peers, until the performance differential becomes so obvious that resistance crumbles. The excuses are already prepared for when the dam breaks. Fiduciary duty requires seeking the best risk-adjusted returns for beneficiaries. Modern portfolio theory demands adaptation to new asset classes as they mature. Risk management necessitates avoiding assets with guaranteed negative real returns. The language will be bureaucratic, but the message will be clear. We're finally doing what the analysis demanded all along. The historical performance differential makes the case impossible to refute. Bitcoin has delivered 60% plus annualized returns for 15 years, while bonds have destroyed 2 to 3% of purchasing power annually. The question isn't whether institutions will adapt their allocation models, it's which one will have the courage to move first and claim the performance advantage that comes with intellectual honesty.
Yeah. I mean, this chapter is really it's more about the collapsing system.
Right.
And the impending death of bonds. So what are people going to trust in the future is the question. Your advantage. While institutions remain trapped by committee dynamics, regulatory constraints, and career risk considerations, individual investors possess an enormous advantage: freedom. We don't need actuarial consultants to approve our allocation decisions. We don't require regulatory permission to recognize reality. We can abandon bonds today and allocate to Bitcoin, while institutions spend years debating whether the logic applies to their portfolios. This freedom represents the greatest wealth building opportunity of our lifetimes. When 130 trillion in institutional capital eventually rotates from bonds to Bitcoin, and it will, because the data wins, individual investors who moved early will capture the appreciation that comes from being ahead of the herd rather than a part of it. Consider the magnitude. Bitcoin's current market capitalization represents roughly 3% of the global bond market. If just 10% of bond capital rotates to Bitcoin over the next decade, it would represent 13 trillion in new demand for an asset with immutable scarcity. The price appreciation from such flows would be extraordinary, potentially driving Bitcoin from current levels way past 1 million.
Yeah.
The opportunity cost of holding bonds while this transition unfolds is devastating. Every year spent in negative, real yielding government debt is a year of wealth destruction that cannot be recovered. Meanwhile, every year of Bitcoin ownership has historically delivered returns that compound wealth at rates seemed impossible until they happened. The choice is binary. Hold government promises that guarantee impoverishment, or own absolute scarcity that offers the possibility of generational wealth. Institutions will eventually make this choice, but only after committees debate, regulators approve, and consultants provide cover. Individual investors can make it today. The bond market's 130 trillion represents the largest misallocation of capital in human history. Productive savings trapped in unproductive government debt that serves only to finance consumption rather than investment. Bitcoin offers an escape route from this trap, a systematically scarce alternative that cannot be debased by political expedience. For those willing to abandon the comfort of conventional wisdom and embrace the logic of monetary, the numbers, the coming rotation from bonds to Bitcoin represents not just an investment opportunity, but a chance to join the future rather than subsidize the past.
Okay, so bottom line, bonds are, so let me just summarize. Bottom line, bonds are a historically bad place to invest recently. They were fine in the 80s and 90s. We had the movement down of bonds with the globalization and, the post-Volcker, we've had globalization through technological advancement, and that worked for 2 decades. It's really stopped working in 2008 because there are no returns anymore. Bonds stopped yielding anything. They're being propped up by governments. These actuarial reasons for owning them make no sense whatsoever, and the 60-40 makes no sense for investors. Oh yeah. So what about all these MicroStrategy things like STRC and STRD? I mean, what we're seeing with those kind of prefers is that the real cost of money that MicroStrategy is willing to borrow is more like 10%. So I think we're going to see this massive dislocation, right, where the government's going to cut interest rates dramatically, and they're going to cut it because they have to. It's the only way they can pay down their debt. They can't pay. We're almost at $38 trillion of government debt now.
And we're just a few months away from that guaranteed happening.
Yeah. Once the government, goes back into session, they're going to push that number beyond 38 trillion. And so,
And then the Fed's going to turn over in May.
Yeah, the Fed's going to turn over in May. They've already sort of thrown in the towel, like whatever, you do whatever you want. Like Powell's basically said as much. He's not even going to fight it at this point. He's also not going to fight quantitative tightening. He said that's over. We're going to stop buying bonds. We're going to stop letting bonds roll off the balance sheet, right? So they're going to be into quantitative easing mode. They're going to be into interest rate reduction mode. They're going to be running the economy hot. Nobody's going to care about the consequences to inflation, and it's going to be bad. At the end of the day, this is all super, super bullish for Bitcoin, and the size of this market, this bond market, you could argue that there are a lot of the stock market that's going to do really well, right? With certain companies like AI-oriented companies, OpenAI, Anthropic. Once those companies go out public, they're going to be the new Googles, right? But the bond market has nothing good to offer, nothing. And it may do okay for a little period when they lower interest rates, but eventually, it's just going to massively underperform Bitcoin, and there's so much room for Bitcoin to grow just from the bond market alone, ignoring the currency market, the cash currency M3 market, which is already the same size as the bond market. It's on 150, right? So put those together, you're almost at $300 trillion. And there's just so much room to get for money to come into Bitcoin. I think that's one of the things that a lot of Bitcoiners don't appreciate, don't understand. And Matthew Mazinskis, who's going to be coming to Bitcoin Alpha, really kind of cataloged that out really well. And so that's going to be a subject we talk about there.
Right.
So that's it.
That's it. Now, the next chapter is going to be real estate.
Yeah.
Which was when I asked the engineer at the recording of the audiobook who heard all the chapters, I was like, which chapter really stuck with you? He's like, that real estate one, honestly, because I always thought of real estate as being so safe, but you have that one story about your investment in real estate doing so bad compared to Bitcoin. And I never thought of it that way.
Yeah. I think these big asset class, the book's really focused on these asset classes, right? And
the first third or
the first third, yeah. And, I think we still have a couple big asset classes to go. We covered stocks and bonds, but we need to talk about real estate and gold.
Real estate's big.
And real estate,
the biggest.
Real estate is the biggest asset class and the oldest, right? Because it predated the stock market, considerably. All right, guys. Well, that's it. Hope you've enjoyed the reading. The book, of course, is Bitcoin 1 Million. The bad author's copy, but it's available in paperback, Kindle, hardcover today.
Audiobook soon.
And
soon in translation. So if you have a certain translation you want to see first, write to us. Let us know.
Yeah.
We'll be translating every language.
Hope you enjoyed the book, and
Thanks for
talk to you
tuning in.
guys soon. Thanks for coming by.